So we've talked over the past couple of months, and as we're seeing this transition of high growth stocks getting sold off, this rotation into value, I've talked about this in the past. There's a company called Upstart, and they're an AI, artificial intelligence platform. They provide platform technology to banks for lending services and things. And it's easy to categorize, Frank, here. So what I want to try to do is separate. We're not saying we don't want to paint with too broad of a brush. Yes, the market is selling off high growth stocks. Upstart has gotten absolutely smacked. I don't know if you're pulling that up over there. UPST, Frank, if you can.
Yep.
And you can look at this chart that has gone from, let's call it 100 to 400, and then 400 back to under 100. And it's popping over 20% today, or at least it was a few minutes ago. I say all that because I'm not saying the sell-off is over, volatility is going to continue, but this is worth looking at right now and putting on your watch list for a couple of reasons. One, this is a high-growth stock, but it's not a broke high-growth stock. So you have your category of high growth, no earnings. Those are going to continue to get punished as interest rates continue to rise and anticipate rising further. This company is actually profitable. Still trades at a very high PE, so I'm not attacking you fundamentalists out there. I think the PE is still over 40. I don't know if you have that up. I think at the price to earnings, forward PE is about 40 times, which is,
It says like 67 times.
Okay, well.
But they just reported.
Yeah, they just reported solid earnings. So let me throw a few numbers at you here. And remember, they are profitable. High PE, but stay with me here. Fourth quarter 2021 highlights. This is year over year to 2020. Total revenue increased 252%. Total fee revenue increased 240%. Mm-hmm. Bank partners originated almost 500,000 loans for $4 billion, and that's up 301% from a year ago.
This price, that's amazing.
Now, remember, this company is profitable. They're not a lender. They provide technology to help lending. And I pulled the conference call transcript. This gentleman, I'm not even going to butcher his name, the founder and CEO, he's an ex-Google employee, big wig at Google, Frank. And I want to point this out. So on the conference call, and this is one of the reasons why we encourage everybody to go through some of these, use the control find, pick some keywords, enjoy this, dig into these companies. He says in the conference call, I'd like to start by reflecting on 2021. We grew revenue from $233 million in 2020 to $849 million in 2021. Mm-hmm. That's a hell of an increase. Yeah. He goes on to say all this kind of stuff. But his vision, here's what really stood out to me, Frank. They're going to get in from personal loans, their addressable market as they get into autos, and everything else. And he references, hey, we're about the same size, $8-9 billion company that Google was when I started there. And he talks about having this vision to be the disruptor in the main space, and Google and Amazon, and those are his North Stars. But he talks about the total addressable market that they're over, then this is over several years, is over $6 trillion in origination for loans. Now, what this product is doing, Frank, and they're proving this, is saying, hey, banks can use this to give more loans for less default rates. And but my whole point to say, and I don't want to come across too much as a cheerleader, because again, I'm not ignoring the fact that this stock got wrecked from 400 down to under 100. My point to say that is that these are the kind of companies you want to look for because yes, they're the high growth, high priced, but if they can grow into these, that's going to be a hell of an opportunity. And when you go through and look at these numbers, Frank, let me ask you as a growth analyst, if you're trading at 40 to 60 times earnings, but you're growing profits and net revenues by a few 100%, you can make the argument that's not crazy. Doesn't mean it's a guarantee for this environment.
People make that mistake, and I'm going to make that clear. And I make that mistake. I made that mistake early in my career where I didn't buy Netflix. I didn't buy Apple when it was trading at 60, 70 times forward earnings because I'm like, that's crazy because I didn't factor in that growth. But yeah. Yeah.
And so my takeaway here is put Upstart on your watch list at least. If you wanted to buy some and gain exposure to this, I would start with the third position or so. But man, when you see, we've talked about, Frank and I are on this big macro theme of stock pickers market, and you want things to trade on their own fundamentals. That's not to say that if the market drops, this company is going to get hit hard. I'm not saying it's proof. They also announced a $400 million share buyback. That's why one of the reasons the stock, on top of the great earnings and growth, $400 million in buyback shows you that the management team is thinking about how to run the stock price as well as the company. Not to focus on that I don't want to get crazy on that, but you want to see leaders that have been there and done that. He's been at Google. He's got a great story. That's the kind of stuff you want to look at in a crazy environment as an investor, because this is a great company that earns money in a high growth area.
Yeah, no, good point.
Frank, why don't you stop me when I get on like that?
No, I like it. Keep going, man. It's cool. Another company that just reported, I found interesting really quick, and I don't forget the 13 apps. Maybe we'll do that next week. A lot of them, that's when all the money managers, over $100 million in hedge funds and stuff that manage, they have to report their holdings for the month, for the quarter. And it's interesting to see, what they're getting into and what they got out of, a lot of window dressing there too and stuff like that. We'll cover that, I think, next time, because I wanted to talk about one more stock here, which is Crocs. When I bring up a chart here of Crocs, I mean, you're looking at, obviously the stock has went up from its lows here in the COVID lows. It was like $10 and it went to 175. But if you look recently, and this is just the past couple of months since November, again, it's you can see this. We were showing the chart on the Curzio Research YouTube page. It went from 180, now it's 96. And it's cool to see that a company, I mean, even though you'd think that they would increase their share buyback, they came out, they reported decent numbers, which is okay. They announced that they're going to suspend their repurchase program, which I think is really cool. I mean, you don't see a lot of companies do that often. And instead, they're going to focus on lowering debt. So they want to keep their gross leverage under 2x, which is above that right now. But a lot of companies don't announce that. I thought that was really interesting, and I kind of like that move. And with stocks higher and risks to the market, I wonder if we see, the buybacks. And you never really have to say you're going to suspend your repurchase program, because when you launch a repurchase, when you say we're buying back shares, it's interesting because you could announce you're buying back 20% of your float, and this is something you could announce, and you'll announce a time period over the next 12 months, 18 months, 2 years, but then you could pull it back. You don't have to do it,
right?
Which is kind of weird, right? Because you don't have to do it, and they'll monitor it every quarter, and they'll mention how many shares they bought back, and the analysts cover this stuff. But you're not like obligated. You're not like locked into doing that. So a lot of companies would be like, okay, we're just not going to do it or whatever. But to make that announcement, I thought was pretty cool being up front. And I think Crocs might be a buy down here. Cut in half. The numbers are still really good. I like they're focusing on debt. Demand's through the freaking roof. But yeah, I guess, this stock is down. I was just surprised to see that. That's something you don't normally see. And I kind of like it. I like the transparency there. More transparency is always good for stocks, and less is always bad when you have that uncertainty. So I thought that was pretty cool.
Absolutely. I agree. I think what stood out to me with this, when you mentioned this, again, playing on the theme of stock pickers market, you want good operators, you want businesses. And this is the great example of trading versus investing. If you're an investor in this company and you're buying shares because you believe in this story and you want to compound your money over the long term, in my opinion, this is exactly what you want to see in a management team. You want them to address debt. It's not always easy. Like you said, it's down 5%. Their guidance was basically in line with the street. There's plenty of wiggle room there. It's not like they came out and lowered a lot. But if you have a management team that is focusing on getting its financial house in order, you have anticipation. Everybody knows interest rates are going to go higher. So as debt comes due, if you're going to refinance that debt, it's going to be at higher interest rates, which means your interest payments are going to be higher. Just to your point about mortgages, it's the same thing for businesses. So as a management standpoint, this is great. From an investor standpoint, this is what you want your management team focusing on. They just made a huge acquisition, bring it in. Now they're going to all sort it out. And I think that's a good idea. This company is crazy because of how volatile it is. And even though after I just talked about Upstart, I've never paid attention to this, but I would follow you in on here. I like that with the management team, and this should help put a floor under the stock. And barring anything crazy or an absolute bear market, I like that move. I think investors should cheer that.
Yeah, no, I agree. I love the transparency there. And this is a stock that, again, if you have kids, I mean, Crocs, everybody. It's just such a massive stock, and huge demand. So huge demand there. They had a pretty good quarter. They lowered expectations a little bit, down 5%. But, this is a stock that really got nailed that I think is really doing the right thing. That could be a buy and you should put on your radar.